Welcome back. The markets are still up close to around 60 points. The IT index, that's the one that's driving the way or leading the way today. Remember, yesterday it was an underperformer. IT index is doing well. Nifty Bank has come off, though, a little bit from the day's stop. Well, let's focus on our next corporate. We have Century Plyboards. That's the stock on our radar. It's corrected a little bit of late. The stock is down close to around 7% in the last 1 year, though. It's corrected a goodish bit. Mr. Keshav Bhajanka, the Executive Director of Century Plyboards, joins us on the show. Hi, Keshav. Good morning. Thanks so much for joining in. Well, let's talk about demand first up. I'm reading a couple of reports, and they suggest that plywood demand is a little bit softish. Could you tell us whether that's the case? While MDF is reasonably positive, what is the outlook on demand and how has it been in Q4 so far?
Good morning. I think you're right. Overall, the demand in the market, the demand sentiment doesn't seem to be very good. I think there are signs of a slowdown, not just across our sector, but across building materials in general. However, having said that, by virtue of the actions that we have taken on ground, we have still been doing fairly well. So I think as far as Century Plyboards is concerned, demand is still okay. We should be doing a growth, and this looks like a good quarter. With regards to MDF, yes, demand is still good. In MDF, there is some pressure from imports, but that is predominantly in southern parts of India. North India being somewhat isolated from the impact of imports has been doing reasonably well, and the demand for MDF remains robust. We have just commissioned our new capacity at the start of this month, and we are gradually ramping up. So I think going forward, MDF should be a good growth driver for us.
Okay, all right. A quick question, follow-up question on pricing. Then I understand in Q4 you have taken a price increase in the plywood segment. Could you quantify that? How much is that? And there are reports that suggest that the unorganized or the unbranded market is coming back. If that is the case, will you have to pull back some of these price increases? So a sense on plywood prices as well as on MDF, because I understand that the export market is down by close to around 4-5%.
So in plywood, by virtue of being the market leader, we do have a certain amount of pricing power in our hands. So we've taken close to a 2% increase. And I don't think, regardless of whether the unorganized sector is bouncing back or not, that we'll have to roll this back. This is primarily due to elevated timber prices, as I mentioned earlier as well. On the unorganized sector, I don't think that there has been much of a recovery. What we have heard from the market is, firms are still struggling, and that is due to the weak sentiment on the ground. With regards to MDF, we were never exporting because our capacity is predominantly in the north of India at this point in time. So for us, that isn't so much of a challenge. Once our capacity in the south in Andhra Pradesh comes into play, then exports will definitely form a part of our strategy. But I think that is going to be towards the end of this year or the start of next year.
Keshav, hi, good morning. Could you tell us what's the split between plywood and MDF? Because MDF, of course, you've expanded capacity significantly as well. And second, the demand slowdown you spoke about, is that a result of general inflation out there, or are you seeing something more sinister?
Good morning. For us, plywood is still predominantly the largest segment, whereas MDF is going to be the growth driver. As you have pointed out very correctly, we have taken a 60% capacity expansion in MDF as of the previous quarter, and we're looking at 100% further capacity expansion towards the end of next year. So MDF definitely being a smaller part of the business, but definitely has a far higher growth potential going forward due to the fact that we are limited by capacity. And secondly, I think that the major reason for the somewhat tepid demand is that interest rates have gone up. Because interest rates have gone up, the EMIs have actually increased substantially. So discretionary expenditure is being pulled back slightly. You're seeing demand for homes is still quite robust, but I think the decision to furnish or to take up that home project perhaps is getting pushed back slightly. I think this is somewhat temporary, and we're going to see a very good, robust demand outlook in the medium term. Short term, yes, you're right. Due to the interest rates, there's a slight bit of pressure.
Okay. Keshav, just wanted to get back to that point on price hikes. Because I think investors want to see if you can start shoring up margins. That's what you had indicated, I think, in earlier conversations. So can you tell us in both the segments, plywood and MDF, what kind of margins are you looking at Q4 and then getting into the next year? What kind of margin recovery, at what levels will you bring them back?
We normally don't look at margins as quarterly. We look at the long-term margins and we give a guidance based on the same. So for plywood, we have revised our guidance slightly. We have said that we would be looking at 12 to 14% in the medium term. Laminates, MDF, and particle board are largely consistent, from 14 to 16% for laminates, 25% for MDF, and 25% for particle board. Having said that, there could be some pressure in the short term, but long term, this margin guidance still holds very well intact.
So that's a slight lowering in the plywood guidance, I would imagine. You said 12 to 13%, right? Where does that leave? 12 to 14%. And where does that leave your outlook on blended margins at an overall company level?
I think our blended margins will be to the tune of 16, 17% plus. Of course, the objective will be to push them further higher. But I think 17% is a safe assumption on the blended margin, considering the increase in the MDF capacity going forward.
Okay, all right. What about your market share? You're indicating that maybe the industry is going through a little bit of a lull, but y'all are doing fairly okay. So if you could give us, what's your sense in terms of market share? I think in the plywood segment, your market share is around 6%, which has improved by around 100 basis points. So where is that headed? And we have your blended margins at around mid-teens. What about top line growth for the company on the whole for FY24?
So the objective for growth is always 20% plus, and I think we are very well in line for 20% plus top line growth in FY24. As far as market share is concerned, the unorganized data isn't authenticated. It could be any figure because it's very difficult to get a sense of what the unorganized play is. Having said that, in the organized sector, I think we have pushed up from 25% of the organized space to 30% of the organized market. So that's close to a 5% market share in the organized space. Slowly, as the unorganized moves towards the organized, this is going to lead to an even bigger overall increase because the size of the organized pie is increasing.
All right. Thanks very much. Good speaking with you, Keshav, and good luck. Let's hope, we are at the higher end of the interest rate curve and there's not very much more to go. But overall, you're still sounding pretty confident with the growth prospects, even though there is a bit of a slowdown, which we're seeing in the plywood segment, furnishings, etc., being postponed, as you said. I mean, the market is doing quite okay, a third of a percent higher, which means we've got about 55 points on the index at this point in time. Paytm is up about 4%, if you can have that up. It was not there in the mix earlier, but at about 605, it's a big volume-led gainer right now. Max Financial has cooled off substantially. It was up 7%. It's up 3.5% now. The other one which has come into the mix is actually two more names. One is Uflex, which is coming up with a 7% gain, 372. Again, large volumes for this time of the day. And then Sula Vineyards, 8% move, 365. And again, it's got decent sized volumes for this point in the day. So just some overall kind of texture and stocks which are moving around. Surabhi.
Okay, well, Prashant, we'll move on to another corporate conversation. And this is a stock that has been on a tear, irrespective of what the market's done over the last couple of weeks. Anupam Rasayan has moved higher. In fact, if I just quote the levels, in February, we were looking at levels of around 578, and today it's 800 plus. Well, the management is with us to talk about the business potential and the plans, and they are looking at more capex, apparently a new plan in Gujarat as well. So let's straight away get to the conversation. Vishal Thakkar, Deputy CFO of the company, is with us. Vishal, good to have you on the show again. So we're hearing that you're putting up some capex in Gujarat. Could you just set the record straight on that first? If yes, what is this all about? What molecules? What will you be producing? And how much is the cost?
Okay, so as you said, we are looking at investment in Gujarat. We are looking at around about 670 odd crores of capex in Gujarat across two locations, which is Jagadia, which is near Bharuch, and Sachin, which is near in Surat, which is where our existing facilities are. So these are going to be brownfield expansions for us, but it will entail an investment of around about 670 odd crores. These are the ones which are primarily going to service our current and existing and the future and potential customers that we have been interacting with. We have been having a very, very, very encouraging and a very, very strong demand that we have been seeing across our full portfolio. So if you see, we had signed an LOI last year, and based on that also we need to shore up our capacity. Second is also from the fluorination side, we are getting a lot of very, 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 very interesting demand, which is what is going to be serviced from these plants.
So what verticals, just again to understand, do they cater to? You said fluorination. So is one plant fluorination? What is the other plant? Again, which segments are you targeting in the other plant?
So basically, in both the plants, what the focus will be in these plants, what the focus will be is service my LOIs and contracts that I had signed last year. And two is on the fluorination side. Large part of it will be going into fluorination, which will cater to my polymers, my pharma, and my agrochem business. So these three, we are getting a very good, interest across Japan, Europe, and Americas, and that's the molecules that we'll be looking at for now.
What is the asset turn, Mr. Tucker, that you'll be getting on this particular investment of around 670 crores? 2025 is when it goes live. So what is the asset turn, and what is the rough margins that you'll enjoy on this sort of investment?
So see, the asset turn will be more than 1.75 times. That is what we'll typically be expecting from here. So that's one. And the margins, it should be equal or better than what we have been doing it in the past. As you can appreciate, the newer, more specialized, more high quality and high value products that we are going to manufacture, the margins are going to be on the upward side.
Okay, all right. So around 1,100 crores, or very, very roughly 1,100 to around 1,200 crores is what you can generate in terms of revenues. I think your gross block is around 1,400 crores, and by 2025 it was going to move up to around 2,100 crores. So at peak levels, what kind of revenues can you do? Can you do in that vicinity of closer around 4,000 crores with these investments, say by 2026?
So the capacity, so see, it will always take a little bit of a time to ramp up also. But if you look at the full capacity, we should be north of 3,000 plus. That number we should be able to deliver in terms of my capacity, right?
Yes. 3,000 crores would be your rough number that you could generate revenue potential by 2025-26, right? Revenue potential.
So I'm talking of the capacity that the revenue that can be generated from the capacities that are installed by that time.
Yes. Okay. All right. And what do you think your revenue number could look like? If this is the potential, what could it be? Give us a rough. I mean, you could have a target 3 years ahead, 2.5, 3 years ahead with the kind of investments you're doing.
Sure. So basically, what we are looking at, historically we have grown around 25+% on our historical growth. We believe that we should be able to continue that growth journey, and that's where we are putting up the capex upfront for these kind of continual growth on our revenue side.
Sorry, so you said 3,000 crores is revenue potential from the new capacity expansions, or the total?
Total. I said total.
Total by FY24, north of 3,000 crores.
Yeah. So let me put it this way: I have my current capacities, and when I complete these projects, put together should give me a revenue capacity of the plants would be over 3,000 crores.
Operating at full capacity, obviously. Thanks very much. Good speaking with you, and appreciate you joining in with that perspective. That's Anupam Rasayan with some business commentary after the announcement which is coming in right now this morning that they are setting up. They're investing almost 700 crores across 2 locations in Gujarat to address their existing markets that they already serve. So big capacity expansion coming on stream. Mitesh is with us for a quick check on things in terms of what the market is doing and what the market is telling us. So far, so good. 70 points or so, Mitesh. What would you do?
Prashant, good morning again. We came down from the highs, but what was a good thing was that we didn't break below yesterday's high. So I think there's still some gap left, about 5-7 points, and that suggests that the near-term direction should be on the upside. So we'll take that kind of a view. 17,300 is what I've maintained as the targets, give and take a few points. So if somebody wants to buy a fresh on the Nifty, I think use yesterday's high 5 points below that as the stop loss level, which is about 50 points. And you have about possibility for 130 point kind of a move on the upside. Having said that, on the stock side also I have two long calls. Buy on consumer. That's something which is reversing nicely on the intraday chart. So buy here with a stop at about 705. Look for targets of around 730 to begin with. And eventually I'm hoping 744, 745 could be tested here. And the other stock is Ultratech Cement Company. It's come off slightly from the day's high, but I think overall remains in a positive chart frame. So here buy with a stop below 73.55. Look for targets of around 7,500.
So many stocks moving around. Mitesh, thank you. Thank you very much for the trades at 10. Mid-cap market is firing away right now. And you've got so many movers. Look at Sula, 7.5% up. Uflex is popping about 7%. Electra Green Tech, that move has started all over again. 5% on Electra Green Tech. Just some of the stocks that are really flying around. I could just go on and on. TVS Electrics is up 13%. So there's a fair amount of stock picking that is underway in the market. It's a good looking mid-cap screen for sure, though the Nifty has kind of cooled off a little bit. The Bank Nifty just turned negative. So that's the pressure point. You should keep an eye out on the Bank Nifty as well. The reason we've got this immediate sharp decline on the Nifty is because of banks, but other parts of the market are holding up pretty okay. So on that note, let's take a very quick break. On the other side, we talk commodities. Manisha Gupta is going to be back with us.
Welcome back. Equity markets have come off a little bit from the top, but let's turn our attention to the commodity space. And Manisha Gupta is standing by to tell us about that one commodity she's tracking. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, there is risk appetite back. We've seen equities come back, and so is the case with metals as well. Overnight, we saw most of the industrial commodities gain up, and within that, copper prices gained up by nearly 2% in the overnight markets. And we seem to be holding those kind of gains in copper and aluminum, not so much in zinc. That has seen some more profit taking coming in right now. Well, it has been about the weakness in US dollar that seems to be supporting, and then hopes of strong demand. All the economic data that has come in from China has been slightly on the supportive side, and that tells you that the Chinese demand could be coming back. The one area that you need to watch out for is the construction and infrastructure. So the US home sales have seen a rise, and this has snapped the 12 months of slide. So the month of February actually coming in on the positive side. Not just US, take a look at the Chinese house completion numbers. And while last year it was a 15% of a decline on an year-on-year basis, this year until now we've seen that number gain up by 8%. So the house completion project numbers also seems to be positive. Copper prices, as I said, have rebounded from a 2-month low that we saw trading in the previous week. Last week, copper prices declined by 3.5%, but we've seen nearly 2% of a gain come in the overnight markets there. Excuse me. Various supportive factors continuing, and when you look at the copper mining and the export numbers from Peru, those also have declined by 20% in the month of Jan on a year-on-year basis. So there are supply concerns not just from Peru but Chile as well. Shanghai copper inventories in the month of have declined to a Jan 2020 low, and the LME copper inventories also have continued to decline. We're looking at them trading at a 3-month lows as well. There is support also from China cutting the reserve ratio, so that also brings demand coming back for many of these metal prices. And copper, being the Dr. Copper, has taken a lot of support from those sectors as well. Trafigura, which is the largest trader of metal, says that the copper prices will hit record highs within the next 12 months because it's not just about construction and infrastructure. It also is about demand for solar and EV that the markets anticipate will start to pick up by second quarter and especially in the second half of this year. These are the copper demand estimates coming in. Remember, 50% of global copper demand comes in from China, and Antique and CRU both believe that this year could look at 2.7 to 2.8% of a demand jump up in this year. That is supportive as well. The markets also are looking at stronger premium in the markets there, and that is what also has been supportive. So whether it's LME and Shanghai, the cash is higher than the 3-month trading, and that tells you that the demand on spot, on ground right now is supportive. Of course, we're all watching out for the US Fed meeting. That would give you further direction. But on a week basis, we've seen copper prices gain up by nearly 3%. No such luck with the other metals, which are still trading in the negative, but copper definitely ruling the roost.
All right, Manisha, thanks very much for that. That's commodities in focus. 60 points, 17,165, just hesitating under an important technical level, which is about 17,180 or so. Above that, a close above that, I mean, I think adds more in terms of confidence to bulls to go long. Now, Bandhan Bank is buzzing as well. Abhishek is standing by to tell us why. Abhishek, hi.
Well, Prashant, the stress has reduced in the balance sheet and you have a new appointment of executive director coming in. So board has approved the sell-off of, 2,614 crores. This is a return of portfolio, a little more than 28% of return of portfolio in last few quarters, and about 2,316 crore, which forms about 33.3% of gross NPAs, which will be sold to ARC or Asset Reconstruction Company. So bank has received a binding bid of 369 crore for the return of portfolio and about 371 crore for the NPA on security receipts basis. So if you take a look at the recovery rate, that's on the stronger side for 14.1% for the return of portfolio and about 16% for the NPAs being sold to ARC. This is much better than the single digit returns that you have seen for other NPAs being sold by MFI players. So they have also appointed Ratan Kumar Kesh as executive director for 3 years. He has joined from Axis Bank. He was earlier in Axis Bank, wherein he joined in 2019 and has handled retail operations across liabilities, asset, card, etc. Back to you.
Okay, got that. Thank you, Abhishek, very much for giving us all the details on Bandhan Bank. Well, if there's one sector that's in sharp focus today, it's definitely insurance, because a lot of these life insurance stocks are flying high. SBI, HDFC Life, Max Financial, to name just a few. We have Surabhi joining in with some of the key triggers, including some pretty solid brokerage commentary that has come in this morning. Surabhi?
Life insurance sector has been in focus since the budget day, where they announced taxing high ticket size insurance policies. Now, CLSA has written an extensive note on the sector, and they say the life insurance players have corrected anywhere between 7 to 24% since the budget announcement. They say that the current valuations factor in 0 to 4% growth in the medium term, and their own base case factors in only 5 to 10% growth in APE and VNB over the next 2 years, as opposed to 12 to 24% prior to the budget announcement. With all the negative priced in, they are upgrading SBI Life from outperform to buy with a target price of 1325, a sell to underperform on HDFC Life, where the target price is also raised to 500 from 460 earlier, and an underperform to buy for Max Financials, and they maintain the outperform rating on ICICI Pru with a target price of 485. For SBI Life, they say that it's least impacted with the budget announcement, and the low cost ratios and strong distributions remains their key strengths. For HDFC Life, they expect a faster increase in a wallet share from 58% to 70%, and that will offset the budget negatives. And for iPru and Max Financials, they haven't factored in any growth post FY25, and they say the promoter leverage for Max Financials still remains an overhang.
All right, Surabhi, thanks very much for that insurance and focus there. Well, 40 points, so not being able to sustain strongly at this point, 17,150, still higher though. We take a break here on the other side, our special segment, it's the economy. Lata will get chatting with Hemant Mishra of Scoop Capital as all eyes are on the US Federal Reserve's decision that is later tonight. Stay tuned for that conversation.
I guess very rarely has an FOMC meeting, the statement that follows and the dot chart been so eagerly awaited as the one that is upcoming in the next few hours, in the next 14 hours or so. The importance is for the market to realize whether the Fed will make a clear distinction between a banking crisis and between an economy that is still fairly tight in terms of labor market and in terms of inflation. Will the Fed keep that two apart and say that we will help the banking system with treasury-related operations and liquidity provisioning, higher repo arrangements, and we will continue to chase inflation? Will the language be hawkish, or will the Fed be buckling in and worrying more about financial stability? There are infinite possibilities as to what the Fed can do. It can play a middle game and say that, yes, it's 25 now, but we are waiting and watching, and we will tackle the banking crisis separately from the way we tackle inflation. That could be a slightly more hawkish statement than what the market is prepared for. So let me first present Janet Yellen's statement, and then we have an expert joining us, but this is the Janet Yellen statement that comforted the market.
The steps we took were not focused on aiding specific banks or classes of banks. Our intervention was necessary to protect the broader U.S. banking system. and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion.
It's very important that the Treasury Secretary and a former Fed chair herself is speaking about, protecting banks on the eve of an FOMC meeting or in parallel with an FOMC meeting. So the Fed definitely has the elbow room to say that Treasury and FIDC are taking care of the banking crisis and we shall focus on inflation. That possibility still exists, though the market is clearly bending towards a 25% rate hike and one and done. That's where the majority of the market is betting. Is it betting too optimistic? Hemant Mishra, co-founder and CIO at Scoop Capital and a very well-known face in Indian markets. He was heading Stand Chart in India some time back. Joins us. Hemant, pleasure having you with us after quite a long time. Okay, where do your sympathies veer? Do you think it's possible the Fed goes with 25, but a way more even-handed statement than what the market is expecting?
Morning, Lada. It's a pleasure to be on your show. So our sense is, the job just got a lot more complicated for the Fed. As again, just pursuing price stability, which is what they did until recently. And, only 2 weeks ago when Jerome Powell took the floor, he spoke about wanting to be more hawkish than he has been. Now he's got to do a fine balancing act, price stability vis-a-vis financial stability. And, the former is a marathon. It's a sprint. It's not a problem that can be wished away. Inflation continues to be high. And I'm in Silicon Valley as I speak, right? So I'm getting a pulse of what's happening out here. And it does look like the financial stability problem is something that they can't wish away. As we speak, there are smaller banks that have approached the government and the Treasury for a lifeline in terms of wanting deposit guarantees for the next couple of years or thereabout. So Jerome Powell will need to kind of, in some ways, do a fine balancing act. Talking specifics in terms of rate hikes, I think he can't not act. A 25 basis point is what I think he should do, but not give any guidance. This is not the time to give forward guidances because there's a lot of tightening, credit tightening that's happening as we speak. In some ways, the Fed's job will get done by the banks, because the lending standards will tighten, given a lot of the smaller banks are not seeing deposits coming into them. And if we were to quantify that, the tighter lending standards that will happen on the back of the run that some of the banks have seen, anyway would have meant a hike of anywhere between 50 to 150 basis points. So the Fed is not required to hike much more than the 25 and maybe another 25 later on. But as I mentioned, it's a marathon, it's not a sprint. It makes sense for them to do a 25 and then pause.
Okay. What is your sense about the dot chart? Will not a dot plot also come in the March 22nd meeting? Will the FOMC members want to keep it flat as it was in the previous meeting? And if that is the case, how will the market read it?
So I think they'd want to keep it flat, or they'd want to keep a slightly downward bias, because if they take any guidance from the markets, and they do, and they use, the dot plot in some ways to also guide the market. But the markets have in some ways gotten ahead of themselves, talking of a 100 basis point rate cut over the next year and thereabouts. So my sense is, as I mentioned, they'll be a lot more dovish than that they have been. They'll continue to talk about inflation being a risk and a Fed having a data-dependent decision-making backdrop. But financial stability is something that will remain paramount, and that would be their immediate concern. So not too much in terms of forward guidance, more in terms of reiterating what Janet Yellen spoke about, wanting to ensure that the system remains stable. An important point, and which is where I think the markets would be focused on, is, how will Jerome Powell look at the situation vis-a-vis Christine Lagarde, who last week kind of mentioned that she will look at separate set of tools for financial stability vis-a-vis inflation, and she's continued to focus on inflation. I'd like to think that the Fed and the Fed members will think of it differently. And they do think that monetary policy has a role to play here, because at the end of the day, the Silicon Valley Bank situation and what First Republic is currently going through is caused largely because of liability-related risks and the Fed hiking up rates in a record kind of manner.
Okay. Hemant, like you said, you are at the moment in San Francisco. What is the sense that the money market guys are giving you? Is the crisis period behind? Or do you think that there will be, I mean, who dreamt of SVB, say 2 months before? Do you think there is still a fear that shadow banks may throw up a problem? Or is this the last of the crisis?
So firstly, they're not shadow banks, by the way, Lata. They are
these are banks. These are banks. What I'm saying is there a fear that, like in the pension guys in UK, is the market fearing that the Fed has taken, the Fed and the FDIC have taken care of the banks, but can there still be problems from other financial quarters?
So that's an excellent question. I think there can be problems, and the UK pension problem is well known. I mean, and the nature of markets, Lata, and you know this because you're such an expert, is the fat tail risks come from a quarter where it's least anticipated. Silicon Valley Bank was seen as the epitome of a new age bank. Took excellent, and they've got a brilliant franchise. They do a wonderful job with the startup ecosystem and their founders, but they did a particularly dismal job of something which is very basic to banking, managing ALM risk. For somebody to set long 10-year duration assets, and that to treasury assets, which are very rate sensitive, is stupid. Even an average CFO won't do that. So there is a banking problem and there is a quasi-banking problem. But I think at this point in time, it's fair to say there's an uneasy calm. So the markets are on tenterhooks. I was there for an investor meeting yesterday, and my sense is people didn't see SVB having contagion across the Atlantic and hitting Credit Suisse, which unfortunately is what happened. So just shows the fragility in the mood of the markets at this point in time. First Republic Bank is a bank which is currently under stress. The stock's down 90-odd%. A bunch of Wall Street banks came in through a lifeline of $30 billion, which is not good enough. I think there are some negotiations happening on getting a liability protection or getting some capital rules waiver so that the bank would get bailed out. So this is not done yet. I think the good thing is the forceful and the decisive action that Janet Yellen is driving is helpful, but it's not done till it's done. So, could you have risk emanate from some of the other banks, smaller banks particularly, and the community banks? Yes, very live. In fact, they made a representation asking for a 2-year guarantee on the deposit. Okay. Now, if something like that happens, I think the contagion gets spread. Contagion gets contained. Otherwise, it spreads.
Okay. Look at it from an Indian investor point of view. Does it all look like, we can say the risk aversion, we are at the moment at kind of, within 5% of the bottom of the markets? Because we are in a sounder position, one would like to think, financially speaking, do you see money returning, FPIs returning to Indian equities?
So we are clearly in a sounder position, and it's not just India, it's a whole of Asia for two reasons. Right? I mean, the Asia, and when I say Asia, I'm saying Asia ex-Japan, ex-China, for two reasons. One is we've not had that steep rate hikes as you've had in the Western Hemisphere, particularly in the US. B is for our banks, the deposit franchise is very retail and as a consequence very sticky, unlike lumpy startup money which could get withdrawn at any point in time. But the second bit also is the duration of the assets. And hats off to our regulators, particularly the Reserve Bank of India, who I have a very high regard for. I remember when I was running Stanchart on the ground, our held to maturity exposure was capped. So when I was digging into Silicon Valley Bank and I saw their held to maturity book was 47% of their book, I said, how on earth can this be allowed? Oh. Because in India you can't do stuff like that unless you had specific approval. So clearly our books are sound, and as a consequence, we will not see credit tightening in India. But the general risk aversion that's going to happen, will that take a toll? Obviously it will. But India and some other pockets, including Indonesia, will continue to be differentiated. in what is going to be a new normal, and a lot depends on whether this spreads or it gets contained. But I think the next few weeks are very critical for that.
Okay, then maybe we should touch base after that. For the moment, things will remain in suspended animation, and our eyes will be fixed on the statement and the dot plot that will follow the FOMC decision, even if that decision is a given 25 basis. There is so much to read up and understand in the next 12 hours. Hemant Mishra, thank you very much for joining us, and we hope we'll be able to chat with you very soon again. Wrap up on Bazaar on that note of waiting. Chartbusters will take the action forward.